The four most expensive words in investing this time is different. Whenever investors tend to speak these four words, they believe things have structurally changed in the world and in the markets, but oftentimes it's just short-term noise, and those investors pay the price. We saw this in full effect in Q2. Now, at first glance, Q2 was a textbook rally. The S&P 500 finished the quarter up 11%. The Magnificent 7 stocks within the index finished up 18%, and emerging markets were higher as well. But this calm on the surface masked a lot of noise underneath. Back on April 2nd, when the US announced tariffs, and they threw the market into a tailspin. The S&P 500 fell 12% in just 5 trading days. Oil spiked, treasuries plummeted, the yield spiked, and there was concerns about stagflation and possibly a new Cold War starting between the US and China. But just as quickly as that panic started to happen, those tariffs got walked back, brighter signs emerged coming out of Q1 earnings. The market not only stabilized, but regained the entirety of that drawdown and finished the quarter up a really strong 11%. So the lesson here is that markets are often hyper-reactive in the short term, but ultimately they recalibrate and stabilize around fundamentals. And that's what we saw to end the quarter. Now, for many investors sitting at home, they don't have time or patience or expertise to try to navigate what is real, what is transient, what is structural, and what is just noise in the short term. And that's our job at Titan. So what we did coming into the second quarter, we had some of our chips off the table, a little bit lower than 100% net exposure. We did take some more chips off the table in April as tariff concerns started to spike. At one point, we had 60% of the market's risk, and that was a deliberate, thoughtful move to try to have less than the market's risk. But once those tariffs got walked back and it became clear to us the market had oversold, we ratcheted back up our net exposure. We finished the quarter fully invested, and sitting here today, we're a very pro-risk asset at this point in time. We're very constructive on the future. Now, that being said, this rally has happened tremendously quickly. We're sitting here at all-time highs in the indexes. Valuation multiple expansion has fueled a lot of this move. So we would not be surprised whether it's something coming out of Q2 earnings, whether it's a slip up in the AI supercycle, something that will catalyze a 5-10% pullback and sell-off. We would not be surprised to see that. But if there's anything we learned from Q2, it's likely to be short-term noise in the grand scheme of things. And it would behoove investors to stay fully invested and let us do the heavy lifting of trying to navigate around those changes. If you have any questions, let us know.